Good evening. Oh, happy Wednesday to you. Glorious hump day. We just keep on getting higher and higher on the episode count. We're on number 12 out of, I think I've got 27 episodes in this series. So we are about halfway through almost. So today we're talking about income and owner's equity. So as a reminder, please enable StreamYard. Click on the three little buttons on the bottom right-hand corner in order to enable it. Enabling StreamYard allows me to be able to see who's commenting. Otherwise, it's just going to come up as anonymous. So I would really like the chance to be able to see who's commenting if you make any comments. So as I do every single episode, I always give everybody a good reminder of why I do this. So you have all of the small business owners out there. This year specifically, we have issues where COVID has hit, and it has hit all of us so hard. And hi, I hope I'm pronouncing your name right, Kirshen Joseph. Thank you for joining me. So in the midst of COVID and everything that's happening, small business owners, many of them can no longer afford a bookkeeper. So they may have had a bookkeeper before, they may not have, but this video series is specifically to help the small business owners that cannot afford a bookkeeper right now. So just because you don't have a bookkeeper does not mean that you should be failing at knowing what your financial health is of your business. So this is for management purposes only. It's so that you can see whether you're making a profit, how much you're spending in expenses, and how much money you're making. This is not to go out there and get a loan. Definitely not. We don't want you going out there buying a house. We don't want you out there getting a Lamborghini or anything of the like. This is not for that. This is specifically so that you can know what your business is doing. It's so important to know the financial health of your own business because then you need to, that way you know when to make adjustments to what. So once COVID is lifted and everything, I pray, goes back to some sense of normalcy, then hopefully things will change. Excuse me. And, maybe at that point you can start looking at bookkeepers and make more money. That's the goal, right? Make more money. Kirshen wants to know what kind of software I recommend. Well, knowing that I am a QuickBooks Online Pro advisor, that's what I recommend. It's easy to use, it's easy to learn, and it's easy to read. So QuickBooks Online, if you have QuickBooks Desktop, please, 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 I beg you, please do not migrate to QuickBooks Online because you are opening yourself up to a huge can of worms and a lot of headaches. I spent hours upon hours on the phone with QuickBooks trying to get things solved because what happens is migration issues or errors end up happening. QuickBooks, for whatever reason, has a really hard time translating what's coming in through the desktop version. And next thing you know is there are opening balances for accounts that were closed decades ago, or there were, every single account that I had in my QuickBooks was wrong. And of course, to my boss at the time, it made me look like I didn't know what I was doing. So I don't want you to be in that position. Your best bet is if you want to migrate or if you want to switch, start fresh. If you're looking to start fresh in January, wonderful. Keep your records. Keep your records in QuickBooks Desktop if you can, because then you can retain them all. You never have to worry about them. It says, thank you, bless you. I got to catch the replay here. Christmas family time may be hard. Super appreciate a video like this, especially for managing online businesses. So, yeah, Christmas is definitely different for everybody this year. So we were just so blessed to be able to get out of California when we did, and now we're in Texas. So we don't have all the lockdowns like California does. So we're able to spend time with our families, as long as it's, you know, a small group of people. But I thank God that we live close to family now. So, okay. So anyway, as always, we always do a review of the following episode, which we had last night. And we reviewed cost of goods sold and expenses / prepaid expenses. What's the difference? So we always make this a very quick thing because we've always got other stuff that we have to go through. Today will probably end up being a shorter episode. There's not a whole lot to cover, but we're going to get through it. So to review, cost of goods sold is the direct cost of producing the goods or services sold by a company. This amount includes the cost of materials and labor directly used to create the good. This can also be called cost of sales. Expenses and prepaid expenses are, this is actually the definition for prepaid expenses, not expenses, but it's a type of asset on the balance sheet that results from a business making advanced payments for goods and services to be received in the future. They're initially recorded as assets, but their value is expensed over time onto the income statement, also known as the profit and loss. So what's the difference between an expense and a prepaid expense? So an expense is something that's taken when you purchase something one time. So you go out there and you purchase office supplies, you get a meal from McDonald's, or your bank charges your monthly fees, or you've just spent money on your electric bill. Those are one-time charges. Those get expensed out. A prepaid expense is something that you take over time. It's entered as an asset, but it's chipped away at to accrue monthly for reporting. So for example, you've got insurance, prepaid insurance. I don't know if you've heard of that or not. If you pay it in advance, in other words, if you are paying for 6 months or a year of auto insurance, and you want to pay that in one lump sum in the beginning, that's prepaid insurance. And that gets allocated for an amount of time. Yearly subscription fees. If there's a publication that you really like, you get it every single month, but you want to make sure that you pay that subscription fee for the year rather than paying per month or per publication. And then there's yearly software fees, as you're aware of. Things like Adobe Acrobat, they give you the option to pay per month or for the entire year. So keep in mind, by doing this, you want to check with your CPA or tax professional to find out how you are filing on your taxes. In other words, there's something called a cash basis and an accrual basis. You want to check with your tax professional to find out which one of those you're filing. If you're filing on a cash basis, you don't have to do this. You don't have to accrue for any of this. You can just take it when it happens. But if you file on an accrual basis, you have to do this. So just check with your tax professional or CPA to find out which one is happening. And let's give you, it's going to get really funky here. Okay, that is strange. It has never done that before. Okay, good. We're still in the sample company. I wanted to show you really quick what we did yesterday. I'm hoping that it is still here. It is not. So it looks like they got rid of it. They get rid of everything every 24 hours for the sample company. So I can't show you, but basically what it was is I took the example of some tax software that I'm looking at because I'm looking to add taxes to my practice starting next year. Tax software is not cheap whatsoever. So if I want to file personal taxes up to a Schedule C, it's going to cost me $14.95 for a year, only 1 year. If I want to make sure that I have taxes, tax software that I can help both personal, small business, and corporations, then that is an additional $999 per year. So $24.95 is what it ends up coming out to if I were to purchase the entire suite. So we used that as an example. And so what we did was we actually took that $24.95 and we put that into prepaid expenses. So you're going to debit prepaid expenses in a journal entry, and you're going to credit whatever account that came out of. So your checking account. And it's different. It's different as a bookkeeper because as a business owner or someone personally doing your own books, doing your checkbook, you look at your checkbook and everything that's debited goes down. Everything that's credited goes up. And even when you're looking at a check register in QuickBooks, that's the way it looks. That's the way it is. But when you're doing a journal entry, it's completely the opposite. When you are going through an asset like a checking account, debiting actually increases and credit decreases. So just a little tidbit there that that you kind of need to know. But anyway, we put that into prepaid expenses, and then every single month after that, until it's completely depleted, you deduct that. You deduct a certain amount, the monthly amount. So you take that amount and you divide it by 12. So you take that calculated amount for a month and you start deducting it the following month after you've made the purchase. And eventually, that's going to run out. But then the very next year, you're going to put it right back in and you're going to start over again. So I wish I could have shown that to you one more time, but QuickBooks Sample Company, it's a sample company there for a reason. So, okay, so let's get into the meat and potatoes, as I call it. Income and owner's equity. What is income? Income is money received, especially on a regular basis for work or through investments. Every company needs to earn a profit to be successful. What's profit? Profit is the remaining revenue, also known as income, after a company has accounted for all expenses. Why is profit important? Because it's an essential outcome of running business. Without an income, employees don't get paid, bills don't get paid. You, as the business owner, do not get paid. Types of profit. So we've got gross profit. Gross profit is the company's revenue minus the cost of goods sold. Now remember, cost of goods sold is the material that you purchase specifically for a job that you are going to be billing the client for. That's a cost of goods sold. Operating profit is it accounts for the cost of goods sold. Oh my goodness, sold, and the cost of operating expenses. See, this is what happens, y'all, when I start rushing through things. Net profit is the remaining revenue after accounting for every business expense, including taxes and interest. How do you increase profit? Well, there's 4 ways. You can increase the revenue, which could mean raising prices, selling more products, or finding customers. You could cut costs, which would include direct costs. Direct costs are related specifically to the development of the product or service, like the cost of goods sold. And indirect costs, which is overhead. It's indirect expenses relating to running the business. It's your office supplies, it's your utilities, things like that. You could remove products, because obviously if you remove products, you're removing those direct costs. Or you could reduce inventory. So you're seeing Black Friday sales all the time. Well, that's a really good way of reducing your inventory. You hold a Black Friday sale. I'm just using that as an example. You're selling as much as you can. Or better yet, another really good example, car dealerships. You have a car dealership that every single year they get brand new makes and models. And it is specific to that year. So they want to sell everything that they have that's older than that year, because they're not going to be able to make as big of a profit on those as what they will with the new years, the new models, because all of the new models have bigger, better, fancier accessories. So what do? They hold all kinds of sales. You'll see the beginning of the year sales. You'll see Labor Day sales. You'll see Thanksgiving sales, 4th of July sales. They hold all kinds of sales to try to get rid of their inventory that is older than what just came in. They're also trying to make room. So that's one way that you can reduce inventory, is by holding massive sales. So let's get back into it here. So we want to take a look at what income looks like in QuickBooks. So let's take you to the chart of accounts real quick. We're going to look at this first. So these are all of your income accounts. You've got a billable expense account. A billable expense account is actually an account. Those are for your cost of goods sold. So when you make a purchase, that purchase is going to cost of goods sold. So you've already got it recorded, but now you need to sell it to the client. So when you're creating an invoice, you actually want to create an item in there, and we'll get into this later, but you want to create an item where it points it towards a billable expense. So then once you create the invoice and you've received the money for it, it's now income. It's not going to take it out of the cost of goods sold. We don't want that. So for this sample company, they've got design income, discounts. Yes, discounts are income. That actually gets put on your report as a negative. Fees. So if late fees, interest, things like that. Although interest might be called interest income. Landscaping services, and they've actually broken everything down this way. For me personally, I don't do it that way. And then they've got labor. So other income is something that I don't typically use unless it's something like interest from a bank. So now if we go up to reports and we look at the profit and loss, because this is, yes, it's an asset, but, well, your income is not an asset. The cash is an asset. So this is all of your income. So remember what I was saying, you've got all of your income and then your cost of goods sold is deducted from that. So this is how we keep track of everything that you've made. And then of course you come down here, you've got all of your expenses. So you take all of your expenses minus your net, well, your gross profit or net income. Okay, so let's get back to presentation. What is owner's equity? Owner's equity is the proportion of the total value of a company's assets that can be claimed by its owners. The amount of ownership you have in your business after subtracting your liabilities from your assets. Owner's equity is important because it helps you evaluate your finances. So what's included in owner's equity? Money invested by the owner of the business. And this is a formula right here. This is a calculation that this is giving. So money invested by the owner of the business plus profits of the business since its inception minus money taken out of the business by the owner minus money owed to others. That is your formula. So it is assets minus liability equals your owner's equity. And I believe, okay, that did not work. Okay, what is going on here? Okay, so from the current slide. So this right here is your formula. That is always your formula to get owner's equity. It never changes. So if we come back here, okay, so can owner's equity be negative? Yes. If the business's liabilities are greater than its assets, it can be negative. The owner may need to invest additional money to cover the shortfall if this happens. When a company has negative owner's equity and the owner takes draws from the company, those draws may be taxable as capital gains on the owner's tax return. What are owner's draws? An owner takes a draw for personal expenses and owner pay. This should not be confused with payroll, and I'll explain why. What are the different equity accounts? So owner's equity, also known as owner's investment, is the money the owner has invested in the company. This is also how we account for any purchases you made for the company from personal accounts. We don't count these as loans. They actually get filtered into owner's equity, and then when you pay yourself back for expenses, it gets deducted from owner's equity. An owner's draw, also known as owner's pay and personal expenses in QuickBooks, is if the owner has made personal purchases with business money, and I highly recommend you steer clear from doing this. I always say, do not commingle your funds. You know, it's one thing to purchase something for the company out of your personal checking account, because then you can expense it. It's something completely different when you're making all kinds of purchases from the business for something personal. That should not be done. And so when you do that, it will, not can, not could, it will be counted as an owner's draw and is determined as income by the IRS on your taxes. That's the capital gains. So every single time you make a personal purchase from the business, that gets put into this account, and that gets put as income on your taxes. So you get taxed on that personally. If the owner is taking pay for their work and they're not on payroll, so a sole proprietor is not allowed to be on payroll necessarily. They're not allowed to be an employee. So for them, they would take an owner's draw unless they are paying themselves back for expenses. This would be considered as an owner's draw / owner's pay. This would also be determined as income on your taxes. So it's just like with payroll. When you're getting that W-2 from, I want to make sure I don't get it mixed up with a W-4. When you get that W-2 from your employer and it tells you how much you made for the year, and you're reporting that to the IRS when you file your taxes, that's the exact same thing. Exactly the same thing. You are reporting to the IRS on your report that you took this amount of money in lieu of a paycheck. So it gets counted as income for you personally. And finally, let's take a look at what this looks like in QuickBooks. So we're going to get out of this report. This is actually going to be in the balance sheet, and we're going to go over the profit and loss in the balance sheet tomorrow. So your owner's equity is all the way down here on the bottom. Remember what I said, assets minus liabilities equals owner's equity. So an opening balance equity is not an owner's equity. An opening balance equity is something that you put in there for a brand new checking account or a brand new loan, things like that. You should rarely have something in this account. We don't actually have anything in here for owner's equity, but if we were to, actually, you know what? Let's create a journal entry. So if we were to enter something, let's say that you paid out something personally out of the business checking account. Remember, debits and credits are opposite when you're doing a journal entry as what you would see in the check register. So you would actually put something, and they don't have it in here as owner's equity. So let's see how we've got it in here. They don't even have one. The joys of having a sample company. So you see here, we've got our owner's equity. We're just going to put it in like that. We're going to create another one. This one is going to be, I'm going to put it in as personal expense. But this is going to be owner's pay and personal, let's say personal use. And we're going to close. Okay, so we've got owner's pay and personal. And we just spent $500. You saw this gorgeous fur coat that you just had to have, but you didn't have your checkbook on you and you couldn't find your personal debit card. So you pulled out the business one because you just had to have it. So we're going to put fur coat on there. And then we're going to take it out of the checking account. Now you've got this. But if we were to create another journal entry for the same date, where you are now putting it into owner's equity, and we're going to credit this one. Actually, you know what? We're going to go back to this one. Now you've decided that you're going to reimburse it. $500 to reimburse for her coat. Except maybe you put it in your checking account, maybe you didn't. For this case, that's what we're going to do. I'm going to make it as simple as possible. Now it's $0. So it's a way to keep track of everything that you have purchased personally. Hopefully you didn't. But it's also a way in order to keep up with how much you've paid yourself in order to get those owner draws, because obviously you need to be making a paycheck as well. And if you're a sole proprietor, you're not going to be on payroll. So you have to pay yourself somehow, right? So that's the way that you want to keep track of that. And obviously, if you're putting any money into the business in order to pay for anything specifically for the business, or you want to invest money in your business so that you have capital. Let's say you've opened it up and you want to put $50,000 in there. That's where you would put that. You could also put it under another account that is slightly different, which is startup costs. But that's neither here nor there right now. So that's it for this evening. Like I said, we are doing the profit and loss versus the balance sheet tomorrow night, 7 p.m. Central Standard Time. Again, this should be a fairly short episode. Oh, thank you, Kirshen. I thought this was going to be a short episode as well, but we did a little bit longer on the review. So profit and loss versus the balance sheet tomorrow. I'm thinking if we have enough time, I may throw 1 or 2 other reports in there. So that's all for tonight. So tune in tomorrow, 7 p.m. Central Standard Time on my personal page. Again, if you want to be a part of it live, then I ask that you send me a friend request if we're not already friends on Facebook, so that you can be a part of it. Otherwise, this will be on Facebook after the fact, and it's also on my YouTube. So I will hopefully see y'all tomorrow night. Good night.